Historically speaking, September has been by far the worst month in the market every single year, but that definitely hasn't been the case in 2025. In fact, in the last month, according to Forecaster, the market's up by about 3.73%, and really it hasn't just been September that's been great, it's been 2025 in general. Year to date, we see green pretty much everywhere we look in the market, but despite this, there's still opportunities in stocks trading close to their 52-week low. So in this video, we're going to be looking at 3 dividend stocks currently right at a 52-week low, a few that I think might actually be decent opportunities. So let's go ahead and dive in. Now, the first company we're going to be looking at is Brown & Brown, and we're currently looking at them on Forecaster. There's a link in the description if you want to check them out. But when we look at Brown & Brown, we can see over the last 5 years they've done quite well, but look at this. In the last year, they've sold off pretty significantly despite the fundamentals continuing to climb. We can see sales has continued to climb. The same is true with net income. And as we know, over the long term, share price always follows the growth of the fundamentals. You can see as net income has grown, the share price has grown. Same is true with sales, same is even true with dividend payments. Now, if you aren't familiar with Brown & Brown, I was writing about them over on Dividendology.com just a little while ago. And a lot of investors misunderstand what Brown & Brown actually does. We can see if we look at their sector, they operate in financial services. And most people think of Brown & Brown as an insurance company, but that's technically not right. They're more of a middleman. Brown & Brown connects customers with the right insurance carriers and earns commissions and fees. So if we actually look at the two main sources of revenue, we have commissions, which is about 70% of revenue, and then we have fees, which is about 30% of revenue. This is essentially when they charge fees directly to customers for specialized services like risk management, employee benefits consulting, or claims administration. And this gives them a huge advantage, and this is something that I love to see out of companies. It creates a capital-light model that avoids the balance sheet risk of underwriting that most insurance companies have to deal with, but despite this, they can still benefit from rising premiums over time. This is one of the reasons I think this stock is interesting. I love capital-light businesses. Think of companies like Visa or MasterCard. If we jump over to the fundamentals tab, let's look at the raw balance sheet data. In fact, let's use the AI financial statement analysis, and this is exactly what they point out. Strong balance sheet. Cash and cash equivalents remain substantial, demonstrating strong liquidity, but at the same time, the company's net debt has decreased. But here's what's interesting. More than 90% of their revenues are generated in the US across 4 different business segments, but they also recently completed their largest acquisition ever, buying Accession Risk Management Group in a $9.8 billion cash and stock deal. Now, this is interesting because it grows Brown & Brown's specialty distribution segment, which is typically one of the areas of their business that has the highest margins. And this will add about $1.7 billion in revenue. So let's put that into perspective. If we go ahead and jump back over to our visuals, we can see in 2024, the company did about $4.8 billion in revenue. And honestly, sales has been growing at a fast rate, revenue growing at a fast rate. But adding $1.7 billion just from one acquisition is a big deal. For reference, that's nearly as much as they were doing in revenue back in 2017. According to Forecaster, we can see they give them a discounted cash flow price per share of about $130.25. When I ran my DCF model and posted it to Dividendology.com a few weeks ago, assuming 11% free cash flow growth, which was in line with analyst estimates, we could see the stock had about 20% upside. And at that time, the stock was trading at about $94, $95 per share, and since then it's even had a slight decline, trading at about $93.78 right now. Next on our list, we have a stock that I'm starting to see get more attention, and obviously the sell-off is part of the reason, and that is going to be Zoetis. Now, if we look at Zoetis in the last 5 years, it's now actually down because the sell-off in the last year has been so significant. In the last year, the stock is down now by about 26.69%. Now, one of the concepts that's really important to understand as an investor, when we look at these share prices going up, going down, we have to ask ourselves, what are the sources of these returns? What does that mean? Well, we have to remember there's 3 different sources of returns. We can have earnings growth, we can have multiple expansion or contraction, and then we can have the dividends paid out. So why is that relevant? Well, we have to take a couple of things into account. To start, if we look at the net income for this stock, we can see it's been growing every single year. If we look at the dividends for this stock, the dividend payments are continuing to grow every single year. So that can only mean one thing. This sell-off has been entirely due to multiple contraction. Investors are willing to pay a lower PE multiple for this stock over the last few years. Sometimes that's justified, sometimes it's not. So look at the PE multiple for Zoetis. We can see at one point it was as high as about 56.8. No doubt that certainly seems pretty high for a stock that's not necessarily a hyper-growth stock. But the multiple has continued to go lower, and as of right now, we can see it's gotten all the way down to about 24.6, which is significantly lower than its historical multiple. Again, jump over to the fundamentals tab. To be exact, 24.61 PE multiple. So the problem isn't earnings growth, the problem isn't they're not continuing to grow their dividends. Again, it's multiple contraction. We can see sales continue to climb, earnings have continued to climb. But to be fair, I do think some of the multiples they were trading at over the last 5 years do seem quite a bit high. I mean, a 40 PE ratio for this stock seems a little high in my opinion, but 24.6, this stock starts to become more interesting. Now, something else we certainly have to point out is a couple of months ago, they released their most recently quarterly earnings. And something that I think frightened a lot of people is they reported a revenue of $2.5 billion, which was only growing at a rate of about 4%. Now, in my opinion, rarely is it worth paying a 24 to 25 PE multiple for a stock that grows revenues at only 4%. But there's a couple of things we have to take into account that the headline doesn't really show you. If we go down to the next line, we can see they delivered 8% organic operational growth in revenue and 10% organic operational growth in adjusted net income. What does that mean? Well, it means if we strip out the currency fluctuations and also the acquisition effects, revenue grew at about 8% and net income about 10%. So the actual underlying business is still growing at a very healthy rate. In fact, I'd argue paying a 24.6 multiple for most stocks that are growing earnings at about 10% annually is pretty reasonable. But on top of this, they also recently increased their full year 2025 revenue guidance, with organic operational revenue growth projected to be about 6.5% to around 8%. And on top of this, if we just look at analyst expectations, we can see the projected EPS CAGR for this stock through the year 2029 is now about 9%. If we look at the seasonality for this stock, it's pretty clear that what's been happening over the last year is not the norm for this company, especially if you compare it to the last 5 or even 7 years. So from a valuation perspective, is there opportunity? Forecaster certainly seems to believe so. They're projecting significant upside for this stock, but let's just see what type of returns we could actually expect based on what I believe would be a fairly simple scenario. If we just assume that they achieve the average analyst EPS projections of about 8.95%, and then assume the PE ratio doesn't change any whatsoever, it stays at its low of 24.38, we can see that our compounded returns over the next few years would be in the 8 to 9% range, and that doesn't include dividends. So to be honest, I do think a lot of the sell-off has been justified, but there's starting to become opportunity with Zoetis' current prices. On top of this, if we look at the British Warren Buffett, Terry Smith over Fundsmith, he's been adding Zoetis into his portfolio in the last few quarters. So definitely a stock to have on your watch list if it isn't already. And then lastly, we have Target stock. And what a disaster the last 3 years has been for this company, not just from a share price appreciation standpoint, but actually from a fundamental standpoint. Look at the drop in net income. Look at how sales has not even stagnated, but even been declining over the last few years. If we look at the last 5 years, the company is now down 44.11%. This year so far, down 35.87%. And even in the last month alone, now down 4.82%. So they're now trading pretty much at a 5-year low. And like I said, it's not hard to see why this has been the case. We now have about 3 to 4 consecutive years where revenues have actually been declining. The same is true with net income. And while dividend payments have continued to grow, and in fact the starting dividend yield looks attractive on the surface, now sitting at above 5%, a company that has declining revenue and declining earnings can't continue to grow those dividends at a healthy rate. And in fact, at some point, if that trend continues, the dividend's not sustainable at all. So Target is absolutely in the midst of what we would call a turnaround play. So where are they in the midst of this turnaround? Well, if we look at the most recent earnings results, this was released in late August, and we could see Target Q2 2025 results. Net sales was down by close to 1%. Comparable sales, which in my opinion might be even more important, was down by about 2%. Really, the only bright spot was that digital comparable sales was up by about 4.3%. And the statement they put out is they're encouraged by their progress in Q2, but we won't be satisfied until Target returns to growth. I sure would hope that's the case. On top of all of this, if we just look at recent political purchasing and selling of this stock, politicians have been offloading this stock pretty heavily in the last couple of quarters. Q1 of 2025 saw significant selling of this stock, and Q2 certainly saw more sales than purchasing. Now, when it comes to valuation, turnaround plays are incredibly difficult to value simply because there's so much uncertainty about what future cash flows might actually look like. We can take a look at what the average analyst is projecting, and when it comes to earnings growth, even through the year 2029, from 25 to 29, earnings growth projections are essentially 0.31%. Again, there's a lot of uncertainty, so who knows what will actually be the case, but I don't even have to run a valuation to know this is not a stock that I would add more shares of to my portfolio. Now, with that being said, the stock is currently valued as a turnaround play. If we look at the trailing 12-month PE ratio, it's now sitting at just 10.23. But here's what you have to take into account. Typically, when we look at a company's PE ratio, we're also accounting for what their future earnings growth looks like. So when you see a stock maybe like ASML that has a high PE ratio, maybe close to 35 or something of that sort, you can decide whether or not that's justified based on how fast they're growing earnings. And in the case of ASML, they're growing earnings at a very fast rate. Well, how do you value a stock that's actually seeing declines in the earnings? You're basically having to bet on the fact that that's going to turn around. So yes, the dividend yield is attractive, sitting at about 5%, and we can see there's certainly a history of growing those dividends, but that's just simply not sustainable long term unless revenue and earnings start growing again. It's very possible for that to happen, but it's just too unclear what the future will look like. So there you go, those are 3 dividend stocks currently trading right at a 52-week low. Be sure to check out Forecaster at the link in the description, and like always, don't forget to like and subscribe to the channel.